Hey guys, Sean here. The markets have been rallying like crazy. It's like we are back in a raging bull market. We have the S&P up above 4,200, the Nasdaq is almost 13,000, and Bitcoin is close to $25,000. And if you're wondering why, it's because of July's inflation numbers that just came out. Inflation cooled down from 9.1% to 8.5%, and the markets believe this is good news. But we need to take a closer look at the economy because it is still in critical condition. A lot of indicators shows that it's on life support, and this rally might just be a dead cat bounce. But more importantly, the inflation data going forward, especially July and August numbers, is going to determine how the Fed will reach their future rate hikes. Because we are heading into the midterms right now, and the US government needs to pull out a win. And if inflation cools down, the Fed can actually stop hiking rates for a while, allowing Biden to declare victory. But it's going to be premature and it's just kicking the can down the road. Now, take a look at the CPI for July. We can see inflation has come down from June's high to 8.5%, which is still very high. And contrary to what Biden claimed about having zero inflation in July, inflation is still a clear and present danger and it's not going away anytime soon. The devil is in the details, and you'll soon see why. Contributing to the cool down, we can see that energy prices have come down by 4.6%. However, food prices have actually increased by 1.1% from June, taking food inflation to 10.9% in July. But here's the interesting thing. We can see that the overall change in inflation from the previous month is zero. So what does that mean? What kind of inflation wizardry is going on? Simply put, each component is really weighted differently, and the final reported number is a drop down to 8.5. And the big danger here is the world all celebrating too early and the Fed giving themselves a pat on the back, Powell giving handshakes to his team saying, "Well done, mission accomplished." Because if the Fed doesn't continue raising rates, this inflation problem will persist. There's still too much liquidity, too much money sloshing around in the system, while on the supply side, all your oil, your wheat and commodities, they are still in a chokehold. Now, a lot of people believe that the stock market is a leading indicator of the economy. If the S&P rallies, this means that we are back in a bull market and the underlying economy is strong. But the situation on the ground and the numbers don't really reflect that. Remember, we are in an official technical recession. We have ticked the textbook criteria needed for one, and that is 2 quarters of negative GDP. It's not about if inflation is high or low, but if GDP is growing or not. And if we look back in history, there has never been a time when the stock market had a sustainable rally during a recessionary period. Back in the recessions of 2008, 2000, 1990, and 1980, the markets always fell. And that's why we need to be very careful about this perceived rally. Let's quickly take a look at the real driver of the economy, which is consumer spending. Remember, consumer spending contributes to almost 70% of the GDP, and if spending really craters, reality will catch up with the stock market sooner or later. Firstly, we need to understand how inflation really affects the middle class, the person on the ground, the person on the street, the average Joe trying to survive and doing his best to build some wealth. Now, the problem with inflation is that it's concentrated on three areas that impact us the most: food, gas, and shelter, and that is sapping away our purchasing power and draining people of their savings. We have the CPI shelter inflation showing an increase to 5.7%, but we have official numbers showing that it's much higher. Bank of America's data shows that rent payments have climbed by 7.4% in July, and for Gen Z, that number is at insane 16%. And the majority of income goes to rent, and if that is rising by over 7%, people's spending is going to get squeezed. They just can't afford to buy anything else. And when it comes to food, we have to get real here. CPI says that it's increased by 10.9%, but what is reality really telling us? The prices at the grocery store have hit the highest increase in over 43 years. We have cereal, bread and milk all inflating at 14 to 15%, and this is truly horrific and it's draining away the savings of everyone. I really don't want us to be tricked by the headlines telling us how consumer spending is still strong today, because it really hides an important fact. The only reason why spending is still so strong is because prices are inflating upwards. The same amount of food and energy is being consumed, but the nominal amount is going up in dollar terms. And I want us to focus on two things that tells us about the long-term health of consumers, and that is the personal savings rate and credit card debt. Now, a lot of big names, including Michael Burry and Jamie Dimon, they are all predicting that people are going to run out of savings by December. In fact, Burry is poking fun at the current market rally and mainstream headlines. He is saying, Nasdaq a bull market because it's up 20% off its low. Who makes this stuff up? After 2000, the Nasdaq did hit 7 times as it fell 78% to its 2002 low. So if we look at the personal savings rate, it is still at a dangerous low of 5.1%, and I won't be surprised if it crashes even lower when the update to July comes. And this tells us that people just can't save. Almost 95% of their disposable income has to be spent to just stay afloat. Taking a look at the consumer and loan credit card data, we can see the amount of borrowed money is flying to the moon. We have spending on credit cards soaring by 20% to over $1 trillion, and people are spending it on cheaper goods, aka the essentials. And this is not a good sign, guys. It shows an economy full of people up to their eyeballs in debt with a dangerously low savings rate today. So this market rally we are seeing could just be a relief rally, and it won't last if people start running out of money real quick. Because remember that these are loans that need to be repaid, right? The average Joe isn't the Federal Reserve, it isn't the federal government that can borrow money for eternity. He will need to pay it back eventually at higher interest rates. And I want us to try to project how the Fed is going to use these CPI data, because it will affect how aggressive they are going to be with the rate hikes. And we know from the past how closely the Fed watches the CPI inflation data. When it hit 9.1% last month, Powell came out with guns blazing, raising rates by 75 basis points. Now, this means it is highly possible for the Fed to slow down its rate hikes for September. I really don't think they will stop the rate hikes completely. Inflation is still disgustingly high, but we will likely see it drop to a 50 or 25 basis points increase. And according to the Atlanta Fed, we can see that the market is already predicting at least a 25 basis points hike by September. They are expecting the Fed to back off. And honestly, there is a chance they might pull back. The US debt is over $30 trillion strong, and if there's a way to reduce the interest payments, at least for the short term, I think the Fed might take the easy way out. Especially when we have the midterm elections coming and Powell needs to make his boss, Joe Biden, look good. Now, what does this mean for the stock market? Well, we'll likely get another rally, stocks will go up because the market is just looking for an excuse to head up. But the fundamental problems in the economy isn't solved yet. It is still a house of cards, and we'll only get a clearer picture in the next 2 quarters. Now, if consumer spending dries up, inflation is still 6 to 7%, and interest rates are only at around 3% max, then the Fed is caught. What then? If they don't raise rates, consumers literally will get into more debt, and when they have to pay it back, spending will crater. And on the converse, if they raise rates, interest payments will go up, companies can't grow, and that means more layoffs, and that means consumer spending will also dry up. But I think a lot of us might be underestimating the Fed's resolve on the other hand. There's a real good chance they will continue to hike rates to crush inflation. They just came out to say a 75 basis points hike is on the cards this September. Plus, we have the Fed President Kashkari saying rates will hit 3.9% by the end of the year. Because if they choose to do nothing, the likely scenario will be one that Ray Dalio predicts, a stagflation hell where the economy slows down, unemployment goes up, and inflation continues to eat away at our purchasing power. Now, there's nothing certain about today's market. It's all about probabilities, and personally, I believe the rate hikes aren't just finished yet. So how do we prepare? Now, the first scenario is simple. If the Fed decides not to hike rates, or if they do the unthinkable and they slash rates, we could get inflation spiraling out of control. We could see asset prices across the board start to rise, and everything will start to soar. Now, we are talking about equities, real estate, and precious metals all taking off because now the dollar is losing too much purchasing power for far too long. It will become a situation of either I convert my dollars into assets or watch it burn up in the atmosphere, and there'll be a mad rush to tangible stores of value. And this is why I hold gold. I'm still buying some gold periodically because if this situation does come to pass, I believe people will start waking up to sound money and realize that they need to protect their wealth. Now, if the Fed decides to continue hiking rates, which I think is the likeliest scenario, especially if they do another 75-pointer, this will crush the economy to the ground and we'll see spending dry up like never before. asset prices will come crumbling down and everything will be at fire sale prices. That's why, on the other hand, I still hold some cash to deploy if that scenario comes true. Am I still averaging into the markets? Yes. However, I've slowed down quite a bit ever since the S&P 500 broke past 4,000. So however you decide to invest, you need to be ready for each of these scenarios because either can come true. There are no easy answers this time and the market is seriously out of whack. We can already see the 10-year yield moving up, showing market is leaving the safety of bonds and piling into risk assets. The sentiment so-called right now is risk on, and we have no idea how far this relief rally can really last. Can the S&P 500 break past 4,300 or even 4,500? Hey guys, anything is possible, right? But I think this will reverse sooner or later. The economy is still too fragile and interest rates are still too high for any fundamental case of the markets heading back or breaking past the previous high. Plus, once the Fed pulls the trigger to hike rates, it's game over for this bear market rally. So we gotta hang tight because the next few months are gonna be extremely crucial and we could see a big change in this sentiment after the midterms. Many institutions believe that this is a trap and not a genuine recovery. We have Citibank saying that this is a bear market rally. Bank of America believes the market is going to trade between 3,800 and 4,200 till the next Fed meeting. I think the Fed will only decide to cut rates down and spur a real recovery once it gets its handle on inflation, and the environment for them to start slashing is one where the stock market is crashing, the economy is hurting and mass layoffs are happening. But until that happens, there will still be more rate hikes coming. Remember the Fed's dual mandate. It's stable prices and maximum employment. You can't affect one without the other. So once the Fed gets a grip on prices, unemployment will go up and then we'll see the true rate cuts come from Jerome Powell. Till then, you want to do the smart thing and not lump sum invest because it has never been riskier to put all your money into one single bet. There's still so much downside potential. So let me know what you think about this market rally. Is this a real recovery? Are the dark days over? Or is this whole situation going to turn around real soon and we are headed for lower lows? Let me know in the comments below. Stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe as we navigate through this market crash and this recession. Thank you guys for watching and I'll see you soon.